Hey, it's Josh Mahony, Chief Market Analyst at Scope Markets. I want to look ahead to the new week for the week starting Monday, the 17th of June. And certainly this week is going to be dominated by central banks. Of course, it comes off the back of the FOMC meeting, which saw them cut the dot plot expectations for 2024 rate cuts, now just down to 1 from 3 last time around. And bearing in mind, we entered this year where people thought we were going to see 7 this year. Certainly, if we've been going through the data and picking through it as we have been, we've been able to see that this has been expected. The continued pushback against the idea that we're going to see a huge amount of rate cuts from the Federal Reserve. It just hasn't been there because of the trajectory of inflation. And certainly, what happened with the Fed isn't necessarily much of a surprise, but things could be different for the week ahead, in particular with the likes of the SNB expected to cut interest rates, or potentially it's not a given, but there is certainly a potential that they could cut interest rates once again, following off the back of the ECB and the Bank of Canada. We also see decisions from the likes of the Bank of England and the RBA as well. So let's get into it. First and foremost, I want to give you that big picture of some of the sort of big ticket items across the board. Monday, a big focus on China as we kickstart the week with industrial production and retail sales. There's a handful of other metrics within that. I believe unemployment rate, fixed asset investment. Then we've got on Tuesday, so overnight, Monday into Tuesday. It sort of depends where you are in the world. This is UK times, but we've got the RBA interest rate decision, ZEW economic sentiment out of Germany, retail sales in the US. We've got trade data out of Japan on Wednesday, UK inflation. This is where we really start to see a pickup in terms of expectations and for the UK economy, a potential volatility for the pound. Thursday, we have that early morning SNB interest rate decision leading into the Bank of England's interest rate decision in the middle of the day at lunchtime. And then on Friday, we have inflation out of Japan, retail sales out of the UK. And whilst I've only got the German PMI figure on here, we've got a host of PMI figures being released over the course of Friday. So certainly, even though we have things sort of heavily weighted in the middle of the week, even Friday, with the fact that we've got a huge amount of PMI numbers coming out, means that we should have volatility maintained over the course of the week. So the first topic I wanted to focus on is the UK. Certainly the fact that we've got inflation on Wednesday, the Bank of England on Thursday, Friday, we've got retail sales, PMI numbers. It should ensure volatility spread over the course of the week for the likes of the pound, the likes of the FTSE 100. And so let's get into some of this data. Now, bear in mind, I'm doing a separate video for this as well. So if you want to see a sort of deeper dive into the numbers, then I'll provide it on there in terms of a lot more charts and what to expect in terms of inflation and for this meeting, or this release, but also going forward, what that could do in terms of the Bank of England. So watch out for that video as well. But for this one, we're just looking at expectations. So markets here pricing a mere 10% chance that we see a 25 basis point cut. Instead, markets are pricing September as the first interest rate cut. Now, what's notable is if we're looking at expectations, you can see here, markets are pricing a potential decline to 1.9% in headline inflation. So the battle against inflation, the battle to get it back down to target is complete. Well, it depends who you ask, because if you look at the core number, it's 3.2% expected, still some way away from that. So it really depends on whether they just want to say, well, the headline numbers hit target and therefore we're happy enough to start cutting interest rates here, or whether the Bank of England says, well, actually that's driven by factors such as energy and food prices, which we have little control over, and monetary policy doesn't influence in the same degree. And therefore our job to drive down core inflation still remains in place. So that's why we're likely to see volatility where you see markets probably reacting to potential headlines of, they've beat it. They beat inflation. It's back below 2%. What could that mean in terms of the Bank of England? Could they then cut rates swiftly the next day? And then the Bank of England potentially pushing back and saying, we still need to be a little bit cautious because the underlying inflation pressures, in particular within services sector, do remain. And so we want to sort of hold on for a little bit longer. Potentially, maybe they do come out and say, we've done our job and inflation's back below 2%. And, if they don't cut rates this time around, then maybe they cut rates next time around. I do think the 10% pricing that we have here for a rate cut is perhaps too low, quite frankly, considering the day before we're expecting to see inflation drop back below that 2% level. What's notable also is that we're off the back of that going to see the retail sales numbers, which of course are going to be particularly notable. It signals sort of demand for goods and consumption levels within the UK economy, which do provide the basis for inflation expectations going forward, but also those PMI numbers with a particular focus on services, because services inflation is pretty much where it's at the moment. And I'll go into greater detail on that front with that additional breakdown video that I was alluding to. So with all that in mind, let's jump into the charts and we'll look at the FTSE 100. So what we have seen is a pullback over the course of the week that's just finishing, and that really feeds off the sell-off that we've seen from the peak in mid-May. So it's been a month of selling pressure essentially here for the FTSE 100. Recent selling pressure comes alongside the weakness we're seeing around the globe, but most notably within Europe. Of course, we have sort of economic jitters with the fact that, well, we've now got the likes of Rishi Sunak calling an election, but the French are contending with a similar kind of position now that we've seen Macron call a snap election. So political concerns closer to home. Then we've got concerns over in the US in terms of inflation and the sort of pass through of those jitters, with the fact that now the Federal Reserve are saying, well, one rate cut this year. Yes, they've added one onto next year, but quite frankly, the only time that they're relatively accurate with their expectations are when they're just around the corner from doing something. They can probably tell you what they'll do in the next month or two, but if they tell you what they're going to do over the next year, which is, we've seen this play out recently, invariably they're very inaccurate because their expectations, their forecasts for things like growth and inflation are generally well off. So you can see this sort of risk off play coming in, but it's not necessarily too much of a bad thing, because what that gives us is this sort of breather. The trend has been bullish for this market over the course of the sort of post-pandemic period. That recovery continues, but now we're seeing this market really taking a breather as we pull back towards what looks like most probably trend line support. If we sort of try and clip up the bottoms here, let's just see exactly, if we join those three together, where we come into. So you can see we're approaching this potential trend line support from a Fibonacci standpoint. We can see, let's see where we're coming into. It's a midway point. This looks like a sort of 50% to me, just by eyeballing it. So just past the 50%. So, we're getting deeper. Certainly, if we get back down towards that trend line support and that 61.8, that looks particularly interesting, a potential bottom. That could be the kind of time when we see the likes of the CPI number coming out. And I think if we're looking for a boost in terms of this market, that CPI reading is likely to provide it, because if we see a drop below 2%, suddenly people start thinking, oh, great, we've got interest rates around the corner, interest rate cuts around the corner. And then it's down to what the Bank of England come out with in terms of commentary and of course, their decision. You never know. They could cut interest rates this time around, even though it's not expected at 10%. But so we've got the potential for a good news story around the corner for the UK. The key thing here is that we've got a wider bullish trend. We're pulling back into trendline support. We can see from a wider perspective. Just wanted to bring this up. If we look in terms of the likes of the UK sort of FTSE 100 against the DAX, which is this orange line, you can see long term the UK underperforming against its German peer. Now, if you look at the likes of the UK FTSE 100 against the S&P 500, a similar kind of trend. And so, that could tell us a couple of things. First and foremost, it could say, well, if you're bullish equities, don't be bullish to FTSE 100 because by and large it underperforms. And we have seen historically at times of market optimism, the FTSE 100 underperforms. At times of market fears and concern, where we see markets selling off, generally the FTSE won't sell off to the same degree. So it's almost like a sort of less volatile version of these other markets. But nonetheless, if we do start to see it feeding through that, hey, the UK economy is going to start pushing forward because we're going to see interest rate cuts, then, do we see a bit of a pushback against those ratios, against those relationships, and a bit of outperformance for the FTSE 100? Possibly, but certainly the weakness we're seeing at the moment, considering we're coming in towards this trendline support, at the same time we're expecting to see inflation drop below target, there is a possibility that we see the bulls coming back into play over the course of the next week. Then jumping back into it, I just wanted to bring up the Swiss National Bank. We've got the SNB with an interest rate decision on Thursday. So 1.5%, you'll notice if you're comparing 1.5% to some of the other central banks, there's a big difference. And we can see that exactly here. You can see the sort of bright green line at the bottom. That's the SNB, some way away from many of these other central banks. And so, we're already starting to see it rolling over. Some of the other central banks have cut interest rates. You can see the ECB have done so. The likes of the Bank of Canada have done so. But the SNB have already cut rates. And now there's an expectation that we could see them cut rates once again. You can see here 57% expectation of a rate cut this time around. And then if you're looking sort of towards the year end, the expectation is there's roughly a 40% chance that we see another rate cut. So the potential for 3 rate cuts this year for a central bank that already has interest rates that are very low compared to some of the others, that provides the basis for a potential carry trade against the Swissy. And so I just wanted to bring up the dollar against the Swissy and just show you exactly how things are setting up from that perspective. So dollar Swissy, we can see, has been selling off of late. See from a wider perspective, you can see here the trend has generally been bearish, favoring the Swissy over the US dollar. Now, we did see a significant rally back towards that major swing high that we saw here. There you go, at 9245. But we're rolling over from there. So the question mark here is, are we looking to continue this trend? And the fact that we rallied into but not through resistance means that we're going to continue that trend and see a significant sell-off, potentially. Or are we seeing a pullback within this wider trend, and therefore, what we're seeing here is a retracement phase? And in which case, let's look at the sort of fib support. We can see here, we're sort of back down to that 61.8 fib. Do we start to regain ground from here? Possibly. But certainly the trajectory, if you're looking at that trajectory compared to what we're seeing at the moment, certainly there has been a slowdown. But this pullback at the moment, I think, considering the fact that markets are expecting to see a potential rate cut, if we do see a rate cut, we could see some potential Swissy weakness and the potential for a near-term pop into sort of 905, 991 kind of area for this currency pair. But of course, if we see them fail to cut interest rates, possibly you see a little bit of strength for the Swissy and another decline back down towards that 76.4 Fibonacci level. But certainly, considering the inflation problems that the US looks like it's going to continue to contend with, and considering the fact that the SNB look likely to continue cutting rates through this year and moving forward, there is a good possibility that we do see another bout of strength coming into play before long for dollar Swissy. So keeping a close eye out for this one. Is this a sort of bottom that we're forming at the moment? You can see here that we broke up through the swing high. We're now tentatively creating higher lows. We've seen a sharp move high and then the gradual move lower. Could we rally up from here? It's going to be an interesting one. It's a key one to be watching over the course of the week as we head into that Swiss National Bank interest rate decision on Thursday. And then finally, let's just jump into things from an Australian perspective. The RBA interest rate decision is taking place on Tuesday. I probably should have put this at the front of the show, considering it's the first of the 3. I have provided a wider breakdown for this meeting, so make sure to check that out on YouTube as well, giving you some sort of wider details around the Australian economy and expectations from the RBA going forward. Key to that is the fact that, whilst it says we haven't got the forecast in it, the forecast is nothing. And quite frankly, the forecast for the year is nothing. So inflation pressures in Australia continue to thwart the RBA. 1% for the last quarter, setback expectations. People started questioning whether we're more likely to see an interest rate hike this year than a cut. The Australian economy faring relatively well. We've got soft landing, but not so soft to really concern the RBA. So I think they're at a relatively good position at the moment. We don't think that we're going to see an interest rate cut or hike this time around, and we can see exactly that with the expectations here. I've given you a wider view here. Let me just get my head out and go bigger on this so you can see a greater detail. So expectations have shifted somewhat in favor of a potential rate cut in December, and that wasn't the case not so long ago. Before, the expectation was we're going to see flat rates over the course of this year, and the only potential move is a possible rate hike and very small chance of a rate cut. Well, that's started to shift, and this is where we could potentially see the volatility coming into play. If we see further pricing towards a rate cut in December or a rate cut this year, then we see the possibility of weakness for the Aussie dollar. Perhaps we don't. Perhaps we see them pushing back against that. We did see recently the jobs data coming out of Australia. I'm just trying to bring it up as good as my memory is. I think we saw unemployment remain at 4%. So unemployment dropped down to 4%. We saw the employment change figure coming in higher than expected, 39.7. So relatively good jobs report. You would think that that wouldn't necessarily make people think too much about the idea that we're going to see an interest rate cut this year. But ultimately, that's the way that things are going at the moment. And really, it's going to come down to this meeting and the sort of outlining of expectations for the RBA that should move things along. But certainly, this could be an outlier because the RBA could be one of the only major central banks to opt against any interest rate cuts over the course of this year. There is a chance the FOMC do exactly the same, but at the moment they're not saying that. And so if we do see the RBA essentially outline their view that they're not necessarily going to do anything this year and they're just going to hold out, then we could see some potential strength coming into play for the likes of the Australian dollar. But like I said, there's question marks in both directions on this. Now, in terms of the Aussie, I thought that it would be interesting to plot it against the Canadian dollar, a fellow commodity currency. This is the weekly time frame. We can see that the long-term trend is bearish. But what we've seen at the moment looks relatively bullish for the Aussie dollar over the near term. And that's because we've got this higher low in play, the breakup through this resistance around 907. And then we've seen this pullback in mid-May and then pushing higher once again. You can see here the rally that we saw over the course of Wednesday curtailed with that Australian jobs report and starting to pull back a little bit since then. But really, as long as we stay above this key support level, then it looks like we're potentially just seeing more of the same in terms of this uptrend that has been playing out. The rally up into this sort of 918 level, pulling back once again. And we're going to see a sort of fib retracement here, potentially, certainly, coming into relatively deep levels. Let's see where we are at the moment. So 61.8. So possibility that the bulls come back into play here with a break below 9048 required to negate that view and point towards a wider rolling over for this market and a potential retracement of the rally up from 878. Until that happens, ultimately, we look likely to see further strength coming into play here for the likes of the Aussie dollar against the Kiwi dollar. And certainly if the RBA come out and decide to outline a relatively hawkish stance and the strong possibility that they keep rates steady over the course of this year, with the Bank of Canada, of course, cutting interest rates recently, that could provide the basis for further upside for the Aussie against the CAD. Of course, keep an eye out for any movements within the energy markets, given the close correlation between the Canadian dollar and the value of Brent crude and WTI, which is one of their key export markets. So energy remains a key part of this as well. But certainly as things stand, the pullback that we're seeing over the past couple of days does provide the potential for another rebound to play out here for the Aussie against the CAD as we move towards Tuesday morning's key RBA interest rate decision.